Hi. CPI's out. Shocker. Market is screaming. Are we going to be up 5%? We're going to break it down today on Options Brew TV with the guy. Hola. Jason, you okay?
I think we're up 5%.
I think
I'm calling.
Good, Jason. Okay, the NASDAQ is up 4.68% or 65%, up 473. Dow's up 755. SPOOs are up 125. Holy camole. Someone tell me what's happening. It's CPI day, obviously unbelievable number, at least purportedly. What do you guys make of it? Don't all rush to the front line at once.
I think Jason's our resident economist.
Well,
I think we need to drop this in his lap. Yeah.
No. Well, the month over month, I haven't looked at the report in detail at all. So really, I'm just looking at headline numbers. The fact that the monthly report has dropped maybe a couple basis points, encouraging. It's probably base effect. Last October, the month over month was 0.9, so that drops off, and now we're looking at 0.4, 0.3. So it's looking. I think the base effect makes it look a lot better for the economy than it really is. But it's hard to deny though that there is some slowing. So
yeah, I can't even say that I have 1,000 out of the money SPX calls today, so I didn't see this one happening at all. We're going to get into the election results or lack thereof for a little bit here. Before we go there, though, there's a couple items in between. So, Jason, is this also a dealer positioning sort of thing? Could there be a gamma slingshot here of sorts?
Absolutely. Yeah. So earlier in the week, we've been seeing a lot of, for the past like 2 or 3 days, we've been seeing a lot of put buying at like the 3,800 level, 3,850, 3,875. And for whatever reason, maybe it's the whole Bitcoin thing or, the FTX thing or just put buying, the market dropped and made all those puts in the money. And because they are in the money and dealers are heavily hedged short on those puts, they now that we're rocketing up, they're going to have to release those hedges, and those in the money puts are plentiful up to 3,900.
Really?
So
that's interesting.
So this rocket is not as much of a surprise to me. I did have some calls.
So we're right around 3,900 now, right? So if we glare through 3,900 with any sort of speed, velocity, we could see an even bigger slingshot because these dealers are going to have to kind of start grabbing some short deltas back. Yeah.
Well, I think it'll slow down after 3,900, but yeah, getting up there. I mean, people are going to be unwinding their puts.
Yep.
And, dealers are going to have to unwind their hedges in response. So, I think it can get up to 3,900. I think it already hit. Did it already hit 3,900 pre-market?
Yeah, it's pretty close. It's close.
And there could be some momentum past there.
Okay, got it. So,
and are these positions, Jason, you're talking about in the Nove Expo, the Nove Serial Expo next Friday?
He's
this
like
Friday.
a statue. He's frozen. We're gonna get him a better set of internet speeds or something like that.
I'm talking. I can hear you.
I know, but you're all globbly glicky. So
you can hear me?
Tell the kids to stop playing Call of Duty down in the basement Wi-Fi. No, so go ahead, Mark. Ask your question again.
I asked if it was next Fridays that he was looking at, if he was looking at the Serial Nove Expo, but it sounded like he was looking at this Friday's.
Yeah. Yeah. He disappeared anyway. So he'll be back in a second. But hold on, here he is again. Jeez, are you for real?
It's better.
Yeah, it's better.
Sorry. You just got a glimpse of my min area behind me.
But this leads into something else, though, Mark. Are you asking serial versus serial, meaning the regular expiration? versus the zero DTEs thing. So I know you had a comment about, the zero DTE equation here. And all that is a 0 days to expiration. You sent over an article before the show, how it's not as much retail as we may think trading these things. Is that kind of the gist of the article?
Yeah, I mean, we've been talking a lot about the zero DTE options. I know Jason looks a lot at them and Volin too. And I think it's no surprise to anyone that's been watching the options market in the last 6 months that these zero DTEs are having an impact. And we've even discussed a little bit the composition here that, it sounds like it's a total retail product. It sounds like that's the perfect sort of lottery ticket that your, Robin Hood buyer loves to just throw nickels and dimes at. But really, it's actually been used quite a bit by professionals for risk management. We've talked about that. We've talked about how it's I think this is Jason's expression about some of the cheapest Greeks you can get are in those near to the closest to expiration options, which is a great way to frame those.
Right.
What surprised me about this study, and I believe it came out of JP Morgan Asset Management. So none of that, I think we all know that most of the participants do, the overall volume numbers that they're contributing. But what was interesting to me, and especially on a day like this, was how much stronger the impact was to the upside. So what the group was looking at was by how much the zero DTE flow can impact the market overall, the returns on that specific day. And they saw, I believe the numbers were, it can drag the market down by 60 basis points, or rally the market by up to 110 basis points. So you almost see twice the impact on the upside from these zero DTEs unwinding, which I thought was an interesting dynamic for them, right? Just how much stronger it is. And, we certainly could have seen a 3% down day here, but, the jet fuel at 831 was pretty incredible.
Yeah, that's interesting. Huh. Wow. I never thought of it that way.
I have a question, Mark.
Good point. Go ahead, Jason.
So how did they determine the impact that the zero DTEs have? Is it historical data?
Yeah, it's a great question. I sort of had the same myself. They didn't get in too much to their methodology of how that was impacting it. It's probably a great question.
What I see in the zero DTEs is a lot of puts. Dealers are short a lot of puts and long a lot of calls. And I think because it's the zero data expiration, and especially recently, we've seen a lot of resiliency and implied volatility up to the last minute, that getting to that last minute, that Vanna decay, as long as you don't go down past those put strikes, you get all the way up to those call strikes. And I've been seeing a lot of that. Let's see whatever the strike call that is most bought or most sold, I guess, by customers is almost, it's like an 80% chance you're going to meet that call and then stop. It's that big Vanna spike. And and it has been every 1% move has been related to that. And they all seem to happen in the afternoon when that implied volatility begins to wind down.
Yeah, that's interesting. So what do you think about strategy wise? What sort of things could work for folks in terms of positioning with options? Knowing where the dealer trouble spots are and not so trouble spots. So any suggestions around that?
Well, one thing Mark has pointed out is that I've been looking at this for a while. We've done some kind of flow charts, have some heat maps and stuff about how much Vanna there is over a day as the market moves. And generally, I haven't released my zero DTE tool or anything, but in general, when the strike that I see on it, if you did that strike, you're probably often than 60%, but the percent you win is, you're making double what you lose. So, I know there's a couple of people that follow me that do that, and they're like, yep, they ask for a day. What's our Vanna strike today? I'm like, oh. I don't do that myself. I kind of, but I sometimes I wish
I like
did.
it. The Vanna White strike today. I like it. Very good. I love it. Okay.
I mean, the other thing too is you can look at OI.
Yeah. Oh, I mean open interest.
Sorry, you can look at the daily volume like on the zero DTE options,
Yeah.
and you can see when there's big blasts of them. But I mean, it's kind of hard to parse through all that. It's a pain.
Sure. Got it. Okay. So the VIX is around 23 too, 23, 24 thereabouts. I didn't do my calculation this morning. Mark, any thoughts on that? 23 is what?
Yeah, no, I'm glad you brought that up because I was going to say that's, I think. Sorry, go ahead, Jason.
No, go ahead, Mark. I talked enough.
No, I was looking at the VIX a little bit this morning because we finally slipped back into our normal contango situation. So with the VIX trading at 23, I'm seeing some of these back month futures in the 25, 27 range. DEIS is 25 and a half, Feb's like 27. So that's kind of, I think between the CPI number that just got released now, election news that just came out, the next 5 weeks are a pretty kind of clean calendar, right? The Fed's not meeting again until December. I don't know that we're going to see a lot of event type stuff going on in the next couple of weeks. So I think I can expect a more normal return to both like vol term structure as well as skew structure too, right? I wouldn't be surprised to see a little of that downside skew steepening come back in, right?
Yep.
We've been incredibly flat going into this, so I can definitely see like a long put short call kind of skew trade, working out. Delta hedge potentially, right, to just isolate the skew factor, but right. I bet skew steepens a little bit in the next couple of weeks.
Yeah. So you mentioned the election, right? So I wanted to talk a little bit about that today, what the results could mean for the market. So, what we still don't actually know, especially in the Senate, which way that's going to be. It could be very much a 50-50 split again. So we don't have that answer yet. Looks like I guess it looks like the House is probably going to go more to the Republicans, if I'm not mistaken. Again, hasn't been confirmed. But do you guys have any thoughts around that? What a sort of the government being two-partied now one's not ruling everything. Does that have anything to do with economic policy, in your opinion, and what it could mean for the markets?
I think at a really high level, right, a major component of the fact that Tuesday's over, and like you said, there's still some votes to be counted in a couple states, but like uncertainty's over at this point, right? Like, that's just a big, markets don't like uncertainty. There's a little bit of relief coming out of that. Like, I think today's mostly about CPI. I don't think it's about election. If anything, we crashed yesterday on election commentary, but I think that's a huge part of it. But then midterms specifically, where there's a little bit of a course correction compared to the previous election, those tend to be the midterm round most. Generally, the midterms are a jumping off point for stock. Historically, I think, positive expectancy over the last like 70 years, but it's particularly so when we get a shift back from, like you say, the Democrats controlling, both parties of government or both sides of government, to have a little bit of that course correction where, maybe the Republicans take back the House, that is generally seen as a good thing for investors because it plays into that uncertainty question. There's less likely to be extreme proposals on one side or the other. So that sort of, tension and gridlock Wall Street likes.
Yeah. Yeah. No,
I maybe a budget deficit question.
The one thing I will mention. Yeah. The one thing I will mention is that currently we are in a continuing resolution, which means that we don't have a federal budget that will take us through to the next year. Mm-hmm. December 15th, 16th? I don't know. I just know that we're in continuing resolution through mid-December, and this gridlock can actually cause a problem when it comes to federal funding and passing a budget. The additional thing too is mid-November is when quantitative tightening starts, right, next week. And the Treasury is going to have to issue some bonds as well. So I think over the next couple of weeks, even though there's no news, I think they're could be some news brewing for mid-December, other than CPI. And I think there could be a little bit of a liquidity problem going into late November.
A liquidity problem?
Yeah,
Okay.
it could be.
I think I agree with all these comments. I think the market, as Mark said, doesn't like randomness and uncertainty. I guess that's a better word, uncertainty. And I think we might see a little easing potentially of VIX throughout the year. Now, don't forget, that's not exactly the world's best comment, because we're going into the holidays, and holiday time tends to be very low key relative to the markets. People don't want to shake the leaves with any kind of major news, I don't think. But listen, the world's a moving place. There's a lot of things going on beyond our seashore that could cause a little bit of consternation, right? But I think I like the fact that it's like a two-party kind of party now. So I think I like that better here.
Yeah, as long as nobody gets.
And in many ways, these
on
events,
December.
right, are different than the focus that the market's had over the past couple months, right? Like the market's been so laser focused on inflation. Now we actually have 5 weeks where we don't have to talk about what that's going to be like,
Right.
And we can actually, that there's different information for the markets to digest. And I think, that's what markets do, is digest and price information. So I think I would expect us to be a little bit more normal despite these kind of catalysts.
Yeah. So Mark, you got the collar going, right? You got the long put, short call, a little stock in between potentially if you have it.
Yeah, I like, as a skew trade, I like that as like a hedge trade, right? Like a delta neutral trade. Long put, short call, short stock.
Okay, we're not throwing on like the seagull part of it by buying the. I can't remember. I never remember the seagull. Is it the put spread and the short call, or is it the call spread and the long put? I always forget that one.
Seagull is the put spread with the short call. That's like the JP Morgan trade. And the slingshot is the call spread versus stock or put even maybe,
Right.
where you're short a call spread so that you're long that upside call in case it really rips through. You get that slingshot effect.
Yeah.
Okay.
Hey,
Got it.
Mark, can you clarify your zero delta? I think what you said was long put, short call, short stock, which would be ultra bearish. It's
No, I
long
think
stock, right?
Yeah, he meant long stock.
Sorry, yes, long
Yeah,
stock.
you meant long stock, right?
Right.
I don't want anybody watching to sit there and be like, oh,
Yeah, I'm
delta
creating
neutral.
the ultra bear skew trade.
Yeah, right. That's a good that is an ultra bearish one. So yeah, we're seeing in the marketplace, we're seeing a preponderance. I mean, we're just massive spread trading, right? So, which obviously makes sense. People aren't making single option directional bets as much. They're making directional bets with spreads that are very hedged. In these kind of markets that are moving 2% a day, you can have what looks like a great iron condor on that isn't great in about an hour, right? I mean, it's insanity, some of these moves.
Right.
So, we're seeing a
Historical
lot of
volatility has been higher than
Go ahead.
historical volatility has been higher than implied for the past 2 weeks. Like every single day, the short straddle is getting slaughtered.
Is that right?
Yeah, normally this is the type of environment that you like, it feels like we've been in a sideways market, but a condor is not working out right now.
No.
Typically, like Jason said, for exactly the reason that you're delivering a greater vol than you're selling. Like
Right.
that's not going to be fun on the upside or the downside.
Yeah. Yeah. And I want to make one more point here about what you said there. So, Mark, you and I might have a different opinion on relative volatility. Okay. So what I mean by that is when you compare the implied volatility of options to what the actual underlying volatility has been recently, Jason's saying implied looks too low for the movements that we've been having. Is that accurate, Jason? Okay. So
Yes.
We would look at it, at least in the past, we might say, even though we have that metric of comparison, we might say implied volatility is still high. I'm going to sell it and worry about the movements because I'm always hedging deltas and what have you. Worry about the movements as best I can, and try to fight through it. Where Jason might be saying, conversely, nah, that's not a good play. I'd rather see you buy this higher implied volatility because the underlying is trading so much beyond that value, right? So, Mark, I don't know how you would look at it. In my fear of buying high implied volatility against higher realized is that the music's going to stop one day and you're going to be left holding the bag, and you better get in this chair when you're playing musical chairs that way. So I don't know if you have any thoughts on that before we close it up.
Yeah, I mean, that's what's just been curious about this dynamic, right? We're used to seeing greater delivered vol versus implied vol kind of early on in like a market freak out, right? Like that's the natural state of affairs where the VIX is trading 15, all of a sudden, boom, news comes out and VIX is trading 30 because the market's crashing. Like this far along, 6 months, 8 months into sort of like, a bear market, like to have realized vol higher than implied vol is a little bit curious, right? It kind of is suggesting, like you say, Lex, that like participants keep thinking that it's going to fall in the future.
Yeah.
That every day for the last 2 weeks, people keep thinking in the future it's going to be less. And it's not quite yet, but at some point, like you said, that music's going to stop. Right. So it's a precarious situation. And it's been a funny year for vol because of just how well it's been priced overall. This dynamic of how now we're higher realized is higher than implied. Like, the way skew's been bending. I mean, this has been, every crisis is unique in their own way. It's like unhappy people and Tolstoy.
That's right. All right, Jason, you got a quick thought on that? We gotta shut her down here.
I mean, say real quick that you have to also pay attention to your term structure, because in the 30-day historical volatility, it's been, slightly, it's been on pace with implied, but the 1 day implied has been blown up. Historical has been much higher than implied. So I mean, and then you look out at 6 months, implied is much higher than historical. So that if you're one of those kind of swing traders that like those 30-day options and that's what you like to trade, you're gonna have a different opinion on historical versus implied than like a 1 day, 2 day trader.
Sure, that's a great point actually. So that's a good one to leave on.
Well, we know Lex is a 1 day trader.
Yeah, no, not me. Yeah, well, I can be. I love instant gratification. I wish I knew how to buy low, sell high like that. I had to do with a whole bunch of option positions and then have a hodgepodge. But yeah, tell me how to do that, and I'm in. Sign me up. All right, guys, good to see you. I've got something for next week already, so I'll pass it along over the weekend or early days here, and we'll look forward to another one on next Thursday if you can make it. Sound good?
Sounds good. We'll see you there. Happy trading.
Happy trading. Have a good week.